All right, so big news hit in the wires today. The U.S. is hiking import tariffs.
Yeah.
And we're not talking about small incremental changes here. We're talking significant increases.
Yeah.
And these are targeted specifically at goods coming from China, particularly those in vital sectors like EV batteries, semiconductors, even steel and solar panels. I mean, wow, this is huge.
It is.
And the immediate question that I think pops into everyone's head is, could this be the thing that finally triggers, a global stock market downturn?
Right.
And if that happens, what does it mean for us here, for our investments in the Indian market?
Absolutely. And, it might be easy to just dismiss this as, oh, this is just another trade spat between two global giants.
Yeah.
But honestly, the implications go way beyond just, U.S. and China.
Yeah,
This
right.
could have a real impact on our financial well-being,
Absolutely.
on the value of our investments, the cost of goods, the broader economic picture.
For sure.
And there might actually be, a silver lining for India amidst all this. So, understanding what's really going on beneath the surface is crucial.
It really is. So that's exactly what we're diving into today.
Okay.
We're going to try and unpack the potential ripple effects of these U.S. tariff hikes, specifically on the global and Indian stock markets.
Right.
And we want to do this in a way that empowers you with knowledge, with information, without, overwhelming you with technical jargon.
Right.
So we're going to look at exactly what these tariffs are,
Yep.
how global markets have historically reacted to these kinds of situations,
Yeah.
which is, I think there's some really interesting patterns there.
Yeah.
What this means specifically for India.
Right.
And then also we'll take a look at what various experts are saying about all of this.
Sounds good.
So let's jump right in. First things first, what exactly has the U.S. government announced?
Well, in simple terms, the U.S. has decided to raise taxes, and these taxes are called import tariffs, on a range of goods, and these goods are coming from China. So it's not a general increase, across the board on every product.
Right.
It's very much a targeted move. They're focusing on specific industries.
Okay.
And these industries are seen as, I guess you could say, strategically important.
Yeah.
Now, the official reason given by the U.S. government is that these tariffs are a response to what they call unfair trade practices by China. And one of the main issues they point to is China's use of subsidies. Now, subsidies are basically financial assistance given to businesses, in this case, Chinese manufacturers.
Right.
And the idea is that these subsidies give them an advantage.
Yeah.
They can lower their production costs significantly.
Right.
And that allows them to potentially, undercut their competitors in other markets.
Right. It's almost like one big economic superpower making a very deliberate play against another one.
That's a great way to put it, yeah.
And, when you have economies of this scale kind of engaging in these kind of actions, it just sends shockwaves throughout the entire global trading system.
It really does. And, we've seen this before.
Yeah.
History can teach us a lot here.
Exactly.
Whenever there have been significant trade tensions between the U.S. and China in the past, we've seen global financial markets become very jittery.
Yeah.
There's a lot of nervousness, a lot of uncertainty.
Right.
And, if we look back to the trade war, if you can call it that, between the U.S. and China back in 2018, 2019.
Yeah, under the Trump administration.
Exactly, that period, yeah.
Yeah.
Major U.S. indices like the NASDAQ,
Yeah.
Dow Jones, they saw noticeable downturns.
For sure.
And some analysis shows that during different phases of that trade conflict, these indices experienced corrections, sometimes in the range of 10–20%.
Right. And even the Indian market, it wasn't immune to that.
Absolutely not, no.
During that same period, the Nifty saw a correction of about 10%.
Yeah.
So clearly, when these two giants clash, we feel the tremors here as well.
Interconnected, that's the key takeaway.
Yeah.
You see, global finance is very much it's like a network, a web.
Right.
And when investors worldwide perceive an increase in risk, and trade tensions definitely qualify as a risk factor,
Absolutely.
they often pull back from what they consider to be emerging markets.
Right.
And unfortunately, India often gets lumped into that category.
Yeah. So essentially, this investor caution, it often translates into what we call FII selling.
Right.
So when foreign institutional investors sell off their holdings in the Indian market, it reduces demand for the Indian rupee,
Yeah.
which in turn weakens its value.
Exactly.
And so you've got a weaker rupee, you've got FIIs pulling out, and that generally puts downward pressure on our key indices, like the Sensex and the Nifty Y.
That's right.
So it seems like some degree of at least in the short term, some degree of volatility is almost unavoidable at this point.
It's a real possibility, yeah.
So this brings us to a crucial question, and I think a question that a lot of our listeners are probably thinking about right now.
Sure.
Is this purely bad news for India?
Well, that's the thing.
Okay.
While the knee-jerk reaction might be, oh my gosh, this is terrible,
Right.
and there are sectors that are likely to face some short-term challenges,
Yeah.
it's important to remember that there's a bigger picture here.
Okay.
We need to look beyond the immediate impact.
All right. So let's start with potentially, some of the short-term negatives, right?
Yeah.
What are some of those potential challenges that India might face?
Well, first of all, let's think about Indian companies.
Yeah.
Companies that export
Okay.
or rely on raw materials and components that they source from China.
Right.
Now, with these tariffs in place, their import costs are going to increase.
Okay.
And that means industries like automotive,
Mm-hmm.
electronics manufacturing,
Right.
even pharmaceuticals.
Yeah.
They could see a squeeze on their profit margins.
Right.
Additionally, and we've touched upon this, there's this initial reaction from international investors. When there's uncertainty, they often flock towards what they perceive as safer assets.
Okay.
Things like gold,
Mm.
U.S. Treasury bonds.
Right.
And that could lead to a sell-off of some Indian equities.
Okay. So some potential headwinds there in the short term.
There are.
But you mentioned that there's a bigger picture here.
There is?
And you hinted that there might be some potential long-term benefits for India.
Exactly.
Can you elaborate on that?
So if we connect this to the global economic landscape as a whole,
Yeah.
there's a possibility, and some would argue a strong possibility, that these tariffs could actually accelerate a restructuring of global supply chains.
Mm.
So what does that mean?
Yeah.
It means that multinational companies, right now, a lot of them are heavily reliant on China for manufacturing and sourcing.
Right.
But if that becomes more expensive,
Yeah.
less attractive,
Okay.
they're going to start looking for alternatives.
Right.
And India could be perfectly positioned to benefit from that shift.
Okay. Interesting.
We've got a large and growing domestic market.
Yeah.
We're becoming increasingly capable in manufacturing.
Right.
Our infrastructure is improving.
Right.
And so India could emerge as a preferred destination for manufacturing, for IT services,
For sure.
for electronics production.
Yeah. Yeah.
Some analysts are even projecting a significant increase in investment flowing into countries like India
Wow.
as a direct result of these shifts.
And it's like we might go through a bit of turbulence in the short term.
Yeah,
We might see some dips.
possibly.
But the longer term story
Yeah,
could actually be one of substantial opportunity for India.
could be. Yeah.
Of course, the key is, can India actually capitalize on this?
That's the million-dollar question.
Can we actually make the most of this changing global environment?
Exactly.
So I think, to make this a little bit more concrete, can you give us some specific examples?
Sure.
Like how could this potentially play out?
Well, let's take the electric vehicle market, for example. Okay.
Right now, a lot of EV components are sourced from China.
Yeah.
But if importing those components becomes more expensive for companies in the U.S., in Europe, and other parts of the world due to these tariffs,
Okay.
well, that creates a window of opportunity for Indian EV manufacturers.
Right.
Companies like Tata Motors, for instance,
Yeah.
to potentially expand their presence, increase their market share globally,
Interesting.
or think about infrastructure and energy,
Okay.
critical sectors,
Yeah.
major Indian players like Reliance, Larsen, and Tubro.
Right.
If there's a global move away from Chinese suppliers in these areas,
Okay.
these Indian companies could potentially be in line to secure more international contracts, more projects.
Wow. Okay. So some real opportunities there.
There could be.
But as you said, it all hinges on India's ability to really leverage this.
Absolutely.
So what are some of the things that India needs to do to make sure that we're in a position to capitalize on this?
Well, we need to continue improving our infrastructure.
Yeah.
We need to streamline our regulatory processes.
Right.
We need to create a more business-friendly environment
Yeah.
to attract that international investment.
Right. Make it easier for people to do business here.
Exactly.
Okay. So I think, the question that's probably on everyone's mind is the Nifty wise, the Sensex, are we going to see a crash
Yeah.
as a result of these U.S. tariff hikes?
Well, crash is a very loaded term.
It is.
It evokes a lot of fear.
It does. Yeah.
And while a full-blown dramatic market crash in the immediate future might be less probable.
Okay.
A significant correction.
Yeah.
And actually, the source material that you shared mentioned a figure of around 15% as a potential correction.
Okay.
So that's certainly within the realm of possibility, especially if trade tensions between the U.S. and China escalate from here.
Right, if things kind of deteriorate further.
Yeah.
And we see this prolonged period of heightened trade friction.
Yeah.
Investors are going to get spooked.
They are. They're going to become risk averse.
Yes.
And as we've discussed, historically, that tends to have a negative impact on emerging markets.
Including India.
Right. Now, we also need to factor in the broader global economic context.
Absolutely.
So if these tariffs contribute to a slowdown in the U.S. economy,
Yeah.
potentially even leading to a recession, that's going to have ripple effects around the world.
It will.
And it's definitely going to impact India.
For sure.
Especially our IT companies.
Yeah.
Like Infosys, TCS, Wipro.
Right.
These companies rely heavily on the U.S. market for a huge chunk of their revenue.
Absolutely.
So any slowdown there is going to be felt here.
It will, but one thing to keep in mind, and I think the source material highlighted this really well, market downturns,
right,
while they can be unsettling,
of course,
they're often followed by periods of recovery.
Okay.
And historically, some of the savviest investors have actually seen these times as opportunities.
Right.
They've used these moments of market fear. Yeah.
To make strategic investment.
Right. So kind of buy low, sell high.
Exactly.
Okay. So I think a lot of our listeners are probably thinking, okay, what do I do?
Yeah.
What should I be doing right now?
Right.
Given this uncertainty, what are some practical steps that we can take as Indian investors?
Well, first and foremost, do not panic.
Okay.
Seriously. Avoid making any impulsive decisions based on fear.
Right.
Panic selling is often the worst thing you can do.
It's often where people lose the most money.
Exactly.
Right? Trying to time the market, get out, get back in. Yeah.
It rarely works out well.
It rarely works out well. Okay, so no panic selling.
No panic selling.
Yes.
Well, it's generally a good strategy.
Yeah.
To stick with fundamentally strong, large cap stocks.
Okay.
These are established companies.
Yeah.
They have a history.
Right.
They have strong balance sheets.
Right.
Established market positions.
Okay.
And they tend to be more resilient during times of volatility. Okay, so stick with the kind of the tried and tested.
Exactly.
Okay.
Now, another key principle, diversification.
Diversification.
It's all about spreading your investments.
Yeah.
Across a range of asset classes.
Wow, okay.
So you don't want to put all your eggs in one basket.
Right.
You want to consider things like gold. Which, as we mentioned, is often seen as a safe haven.
Yeah, in times of uncertainty, people tend to flock to gold.
Exactly.
Yeah.
Real estate investment trusts, REITs, and even international mutual funds.
Right, so diversifying geographically as well.
Exactly.
Okay.
And this helps to cushion the overall impact.
Yeah.
If any one particular market takes a hit.
Okay.
Another thing to consider is having some liquid cash on hand.
Okay, why is that important?
Well, if the market does dip,
yeah,
you're in a position to take advantage of that.
Right.
You can buy low.
Buy low. Yeah.
And potentially, reap the rewards later on.
Okay, so have a little bit of dry powder ready to go.
Exactly.
All right. And then, I think one of the most important things, especially when it comes to building long-term wealth, is maintaining a long-term perspective.
Absolutely.
Right. Trade disputes, they come and go.
They do.
They can have a significant impact in the short term.
Yeah.
But they're not permanent.
They're not, no.
So staying focused on your long-term goals is crucial.
It is. And finally, a word of caution about mid-cap and small-cap stocks.
Okay.
These tend to be more volatile than their large-cap counterparts.
Right.
Especially during uncertain times.
Okay.
So a more cautious approach might be advisable there.
All right. So be a little bit more careful with those mid-cap and small-cap stocks.
Yeah.
Now, it's always good to get a sense of what the experts are saying.
Of course.
What are some of the opinions, some of the outlooks that are circulating right now regarding this whole situation?
Well, we're seeing a range of views. Some experts, and a notable example is Mark Mobius.
Okay, yeah.
He's very bullish on India. He believes that India is in a prime position to benefit from this global trend of supply chain diversification away from China.
Right. He's kind of echoing what we were discussing earlier.
Exactly.
Yeah.
He points to India's large domestic market, our growing manufacturing capabilities,
right,
are improving infrastructure as key advantages.
Okay, so he's quite optimistic.
He is.
Are there any dissenting voices?
Well, yeah, there are also some more cautious perspectives.
Okay.
For example, reports indicate that JP Morgan has issued a warning.
Hmm.
They're saying that if these trade tensions between the U.S. and China persist
Yeah.
well into 2025,
Right.
emerging markets as a whole could see a period of underperformance.
Right.
So they're highlighting the potential for sustained headwinds if this trade relationship doesn't improve.
Right, if things don't kind of settle down a bit. So it sounds like, as is often the case,
Yeah,
in complex situations like this,
right.
there's a mix of viewpoints.
There is.
But I think the key takeaway is the most important thing is to make informed and strategic decisions.
Absolutely.
Right? Don't react emotionally
Yeah.
to these market fluctuations.
Exactly.
So to wrap up, let's kind of summarize
Okay.
the key insights from our deep dive today.
All right.
So first and foremost, the recent U.S. tariff increases on goods from China, they have the potential to create short-term downward pressure on the Indian stock market.
That's right.
And this is largely based on historical patterns.
Yeah.
How global investors tend to react to these kinds of trade tensions.
They get nervous.
Yeah.
They pull back.
Exactly.
They move to what they perceive as safer assets.
Exactly. And we also have to consider the potential increase in costs for Indian businesses
Yes.
that rely on raw materials from China.
For sure.
But, and I think this is the crucial but,
Yeah.
this isn't solely a negative story.
It's not. No.
There's also a potential upside for India in the long term.
Exactly.
We could emerge as a major player in global manufacturing and technology,
We could.
especially if there's a sustained shift in global supply chains.
Exactly.
So while a full-blown market crash might be unlikely,
Yeah.
a correction, potentially in the region of 15%, is possible if these trade tensions escalate.
It is, yeah.
And we also have to keep in mind the interconnectedness of the global economy.
We do.
A slowdown in the U.S., a recession in the U.S., is going to impact India, especially our IT sector.
It will.
So for you, our listeners, here are the key takeaways.
Right?
Don't panic sell.
Right.
Stay invested in fundamentally strong, large-cap stocks.
Yep.
Diversify your portfolio
Absolutely.
across different asset classes,
Yeah.
including gold, REITs, international mutual funds.
Right.
Have some liquid cash on hand
Yeah.
in case there are some attractive buying opportunities.
Good idea.
And most importantly, keep a long-term perspective and perhaps be a little bit more cautious with those mid-cap and small-cap stocks in the short term.
Yeah, good advice.
Now, as we wrap up, I would leave you with a final thought.
All right.
Given all these potential changes in the global trade landscape,
Yeah.
what specific sectors
Right.
or even individual Indian companies do you think are best positioned to not only weather the storm, but actually thrive in the long run?
That's a good question to ponder.
It is, and it's something for you, our listeners, to think about as you navigate these interesting times. So, until next time, thanks for joining us.
Thanks for listening.